Understanding base rates in banking. Exploring the impact of base rates on finance. Agenda for today. Understanding base rates. Base rates form the foundation of interest rates in financial markets. Understanding them is crucial for banking operations. Importance in banking. Base rates are essential for setting loan and savings rates. They directly impact financial decisions. Influencing factors. Several factors, including economic conditions and central bank policies, influence base rates. Keeping track of these is vital. Effects on pricing. Base rates affect both loan pricing and savings rates. Understanding these effects is crucial for consumers. Understanding base rates. Definition of base rates. Base rates are the minimum interest rates set by central banks for lending. They guide banks in their lending practices. Impact on banking operations. Understanding base rates is essential for grasping how banks manage their finances. They influence lending and borrowing decisions. Definition of base rates. Base rates are crucial benchmarks in the financial sector. They influence various financial products and services. Impact on loans and deposits. Base rates dictate the interest rates charged on loans and offered on deposits. They are integral to banking operations. Importance of understanding these base rates. A thorough understanding of base rates is essential for informed financial decision making. It helps consumers make better choices. Importance of base rates in banking. Economic stability. Base rates are essential for maintaining stability within the economy. They ensure predictable borrowing costs for consumers and businesses. Costs of borrowing. Base rates significantly influence how much it costs to borrow money. Higher rates can deter borrowing, while lower rates encourage it. Consumer spending. Changes in base rates can affect consumer spending habits. Lower rates typically lead to increased spending and investment. Economic growth role. Base rates play a crucial role in overall economic growth by influencing credit availability and encouraging investment. Factors influencing base rates. Influence of inflation. Inflation significantly impacts base rates and the overall economy. It's essential to monitor inflation trends. Role of economic growth. Economic growth correlates with changes in base rates. Strong growth can lead to higher rates. Central bank policies. Central banks' monetary policies directly influence base rates. Their strategies can affect economic stability. Economic indicators. Understanding GDP growth. Gross domestic product growth reflects the economic health of the country. It is crucial for setting monetary policy. Unemployment rates. Unemployment rate indicates the percentage of workforce that is jobless. It is a key indicator of economic stability. Inflation levels. Inflation levels measure the rate of rising prices in an economy. High inflation can lead to higher interest rates. Central bank analysis. Central banks evaluate these indicators to adjust interest rates effectively. Their decisions impact economic growth. Monetary policy impact central bank decisions. Central banks set policy rates that influence base interest rates. These decisions directly affect the lending landscape. Impact on base rates. Adjustments in policy rates lead to changes in base rates. This affects borrowing costs for consumers and businesses. Economic activity. Changes in base rates influence lending rates, impacting overall economic activity. This includes investments and consumer spending. Effects of base rates on banking. Impact on borrowing costs. Base rates directly influence the costs that banks charge for loans. Lower rates generally lead to cheaper borrowing. Effects on deposit returns. Changes in bank rates affect the interest earned on deposits. Higher rates provide better returns for customers. Significance for customers. Customers must understand how base rates can impact their financial decisions. This knowledge aids in better planning. Loan pricing. Base rates define loan pricing. Base rates are crucial in determining the price and structure of loans offered by lenders. Rising costs of borrowing. As base rates increase, overall cost of borrowing escalates for consumers and businesses. Reduced loan demand. Higher borrowing costs typically lead to a decrease in loan demand from potential borrowers. Impact on lending activities. Overall, lending activities can be affected negatively, leading to tighter credit conditions. Savings and deposits. Impact of base rates. Base rates directly affect the interest rates on savings accounts. A higher base rate usually results in higher savings interest. Encouragement to save. Increased interest rates encourage individuals to save more. This fosters a culture of saving and investment. Conclusion on base rates. Fundamental banking aspect. Base rates play a crucial role in the banking industry. They affect various financial operations and strategies. Influence on behavior. They significantly impact lending, borrowing, and saving behaviors. Understanding this influence is vital for decisions. Importance for institutions. Financial institutions must grasp base rates implications. It helps in strategic planning and customer relations. Consumer awareness. Consumers should understand base rates to make informed financial decisions regarding loans and savings. Thank you.